Oil prices have been on a wild ride over the course of the past year. They peaked out in early October and then sold off 40% into the end of 2018, hitting bottom the day before Christmas. And then between December 24th and April 23rd, they recovered almost all of their losses before selling off 24% between April 23rd and the beginning of June. So, are there any indicators out there that could foreshadow what might be going on with oil? And the answer is there's a couple of them. And one of the really interesting ones is a skewness on West Texas Intermediate crude oil options. And so when I say skewness, what I mean is the difference in price in terms of implied volatility on out-of-the-money put options versus out-of-the-money call options. So when out-of-the-money put options become extremely expensive relative to out-of-the-money call options, we say that the oil options has a negative skewness or a negative risk reversal. By contrast, if out-of-the-money call options become very expensive relative to out-of-the-money put options, we say that it has a positive skewness or a positive risk reversal. So one of the things that's very interesting is in October last year, right before the big sell-off began, oil became unusually positively skewed. Usually oil has a negative skewness because, contrary to popular opinion, traders are actually more afraid of extreme downside than they are of extreme upside. But last fall, it became positively skewed, preceding this 40% drop. Then, right before Christmas, it became extremely negatively skewed, which actually seemed to give a buy signal, just as it had 3 previous times in the last decade that oil prices were oversold. Indeed, oil rebounded. By April, oil was about 70% or so less negatively skewed than it usually is. And indeed, oil prices then sold off once again before achieving extreme negative skewness in early June that just might be signaling a rebound to come in oil prices. If you look at how oil responds to extreme negative and extreme positive skewness, this chart shows you that when we're in the bottom 20 percentile of extreme negative skewness, that often oil prices move a bit higher over the course of the next 3 months. But when we have more average or especially extremely positive skewness, oil has a tendency to sell off over the next 3 months. Now that relationship holds even more strongly with products like heating oil and gasoline. If you look at heating oil and gasoline, or what we now call ultra low sulfur diesel, I should say, and gasoline, those two markets respond even more strongly to negative and positive skewness. So it's only an indicator, it's not deterministic. There are a lot of downside risks on all of these markets in spite of the extreme negative skewness that we've seen recently. Those downside risks include soaring U.S. production and declining growth in China, Europe, and the United States. On the other hand, there are also upside risks as well, including the growing tensions in the Persian Gulf region.